In 48 hours, a market that usually moves in slow, heavy steps moved like it was falling down a staircase. Gold futures were down about 11%, printing around $4,945. 53. Those are not tough day numbers. Those are something broke numbers. The kind of move traders talk about for a decade, because it violates the normal rules of how liquidity behaves when everyone is watching. And here's the part that should make you stop. This didn't happen after months of bad data. It didn't happen after a long, obvious warning. It happened in a compressed window where price action looked less like a debate and more like a forced evacuation. Not months, not weeks. In a couple of sessions, the screen told you that a trade with a million opinions underneath it suddenly had only one action on top of it: sell. They said this could never happen in deep, institutional markets. They said these contracts are too large, too liquid, too professional to move like that. And yet the tape printed it anyway, right in front of everybody. The reason this matters isn't just the drop. It's what the drop implies about who already knew the mechanism that was about to kick in and who was simply along for the ride. Institutions don't need to know the future. They only need to know the plumbing. They only need to know which levers force liquidation, which rules turn volatility into margin calls, and which moments transfer ownership from the over-leveraged to the well-capitalized. What I'm about to lay out is not a rumor. It's not a personality-driven story. It's a pattern that shows up whenever a crowded trade meets a rulebook that can change overnight. Welcome to Roki Studio Finance, where we decode what matters before it's dinner table conversation. If you like analysis that treats markets like systems instead of soap operas, you're in the right place. And if you've been here before, you already know the routine. We follow the data, we follow the incentives, and we follow the mechanics. Drop a quick comment with where you're watching from, because the way different regions experience this story is part of the story. Now, let's reconstruct what happened with the kind of detail that explains the move without turning it into a myth. The sequence began with a catalyst that didn't look like a precious metal story on its face. Headlines hit around a shift in expectations for monetary policy leadership, with Kevin Warsh being nominated for the top job at the Federal Reserve. Markets don't trade people the way they trade earnings, but they do trade what they think a person represents. In an environment where metals had been running hot, any narrative that hints at tighter policy, less accommodation, or a different reaction function. That shift landed right as positioning was stretched and volatility was already rising. At the same time, metals were already stretched. Silver had recently traded above 120 an ounce before the fall. That's not a small detail. When an asset has sprinted, it becomes more sensitive to any spark because it's sitting on a pile of unrealized gains and borrowed exposure. A crowded, leveraged trade doesn't need bad news to unwind. Then the market did what crowded markets do when the first row stands up. It didn't politely rotate, it lurched. The sell-off wasn't evenly distributed across time, it accelerated. That acceleration matters because it tells you the selling wasn't purely discretionary. Discretionary selling is messy, staggered, full of second thoughts. Forced selling is clean, it's one-directional. It's the market's version of gravity. Once volatility spikes, the machinery starts turning. Clearing firms demand more collateral. Brokers tighten risk limits. Value-at-risk models re-rate the position. And the single most underappreciated accelerator in futures markets shows up: margin requirements. Here's where the story stops being emotional and becomes mechanical. After the plunge, the CME raised margin requirements sharply. For gold, margins moved to about 8% from 6% for standard risk profiles. For silver, margins jumped to about 15% from 11%. On paper, that sounds like a technical adjustment. In practice, it is a sudden, system-wide increase in the cash required to hold the same position. If you are sitting in a highly leveraged silver trade and the required collateral rises, you have two choices. You post additional cash immediately, or you reduce the position. Reduce in a falling market means selling into the decline. But the market doesn't need a villain when it has a rule book. It just needs a crowd. And the most telling detail is that margin methodology itself was shifting. Effective January 13th, 2026, the margin framework for precious metals moved toward a percentage of contract value approach. That matters because when prices rise, the contract value rises, and so does the margin requirement automatically. In a rising market, that can quietly tighten the screws without anyone shouting about it. In a falling market, the exchange can still raise percentages and the effect compounds. That's how a risk system defends itself. To appreciate why those percentage changes are so powerful, translate them into contract reality. The standard gold futures contract represents 100 troy ounces. At a price around $4,145, that contract controls about $500 of notional value. An 8% initial margin implies roughly $37,960 in collateral for one contract, before any broker add-ons. A silver futures contract represents 5,000 ounces. 53, That is about $392,650 of notional value. And the 15% margin implies about $58,898 in collateral for one contract before house add-ons. And it's not just the posted exchange margin. Clearing members often apply house requirements above the minimum, especially in heightened risk periods. That means a trader can wake up to an email that effectively says, your required collateral is higher than yesterday, and it's due now. No debate, no extension. If the cash is not wired, positions are reduced by force. That is why the selling often clusters into the same windows, and why it looks coordinated even when it isn't. This is also why expert commentary can contradict itself in a way that confuses the public. Both can be wrong in the same way, because they are treating a margin event like a thesis event. In a margin event, the thesis is secondary. The collateral constraint is primary. The market can violently reprice while the long-term drivers remain intact, simply because collateral had to be raised quickly across the system. Now, why does that align with the title, They Needed Lower Prices? Now you know why. Because in markets, need usually means one of two things. Someone needed lower prices to meet collateral requirements, to rebalance to control risk, to avoid breaking something. Or someone needed lower prices because they wanted to acquire exposure without chasing it higher. And the only way to do that at scale is to let leverage wash out. To see which need fits, we look for the fingerprints that show up in history. In 1980, silver experienced a legendary surge and then a crash that rewrote risk management. As the price spiked, exchanges raised margin requirements, the cost of carrying positions rose, and the unwind accelerated. The public story became a morality tale about speculators. The market story was simpler. When collateral demands rise in a leveraged market, selling becomes mandatory. And mandatory selling doesn't care about your thesis. In 2011, silver ran hard again and then snapped. The playbook was familiar. Volatility increased, margins were raised multiple times in a short window, and the market cascaded lower as leveraged longs were forced out. People argued about fundamentals while the mechanics did the work. The price fell because the structure of participation changed overnight. Then look at March 2020. Different asset classes, same principle. When liquidity gets stressed, margin calls ripple outward. Funds sell what they can, not what they want. The goal becomes raising cash, not expressing conviction. That's the invisible hand behind many mysterious sell-offs, the need for collateral. So when you see a modern precious metals plunge that happens fast, followed by margin hikes, you're not seeing an isolated event. You're seeing a recurring pattern. Crowded trade, volatility spike, margin increase, forced deleveraging, ownership transfer. Now bring in the institutional movement, because this is where most commentary gets lazy. People will say, smart money is buying, or banks are short without naming the actual levers. Let's name them. The exchange is one lever. The CME sets initial and maintenance margins, and when it raises them, it effectively changes the minimum cash required to play. Clearinghouses and clearing members are another lever. They can require additional house margins on top of exchange margins, especially when volatility spikes. Brokers are a third lever. They can raise margin requirements for clients, restrict new positions, or force reductions. Then you have the large liquidity providers and dealers who intermediate. They hedge, they manage inventory. They care about basis, about spreads, about funding costs. And crucially, they can withstand higher margin requirements more easily than a leveraged retail flow or a small fund can. That asymmetry is the point. Now consider the positioning that had built into silver leading into the drop. Roughly $1 billion flowed into silver ETFs in January alone. That's a huge amount of demand concentrated into a short period. When flows accelerate like that, you usually get two simultaneous phenomena: higher prices that invite momentum and higher leverage that rides the momentum. The market becomes top-heavy. At the same time, central banks have been steadily accumulating gold, not with headlines, but with monthly reports. 5% of reserves. That is slow, institutional demand. It doesn't panic buy and panic sell. It accumulates. And it creates a floor of strategic interest that sits underneath the daily noise. So here's the institutional picture. On one side, you have hot, fast, flow-driven positioning in silver. On the other, you have slow, steady accumulation in gold by official institutions. Then the mechanical stress test hits, and leverage gets punished. This is where the dislocation shows up, and it's the heart of the story. Paper contracts can be sold in seconds. Physical supply chains cannot reprice and reallocate in seconds. ETF shares can be created and redeemed, but that process still interacts with market makers and inventories. Central bank buying happens on a different rhythm entirely. When the futures screen collapses 31% in a day, it doesn't instantly erase the motivations that drove $1 billion of inflows earlier in the month. It does, however, change the collateral math for anyone who was exposed to margin calls and risk limit reductions. So two realities coexist. That mismatches the dislocation, and dislocations don't last forever. They resolve either by fundamentals catching down to price or by price snapping back toward the underlying demand picture once forced sellers are gone. Now, let's make the evidence concrete, because numbers remove ambiguity. Gold was down about 11% to around 4,745. In a market where a 1% daily move is newsworthy, 11% is an event, 53. And that came after silver had traded above 120. So you're not looking at a gentle correction. You're looking at a repricing of leverage, a forced exit from positions that were built on the assumption that volatility would remain manageable. Then you have margin. Gold margin went from about 6% to 8% for non-heightened profiles. Silver margin went from about 11% to 15%. Imagine you're carrying a large futures position. A jump like that means your collateral requirement rises by more than 30% in relative terms. If you were already close to your limits, you don't negotiate with the exchange, you cut the trade. And because margin is calculated on contract value, a high price environment means the absolute dollar margin per contract is already large. When the percentage rises, the cash call can be massive. That is why margin changes can move markets. They do not change the thesis, they change who is allowed to stay. Now, the question becomes, who benefits from a forced deleveraging? Not in a moral sense, but in a structural sense. The most obvious beneficiary is anyone who wants exposure but refuses to pay the top tick price. Institutions with long time horizons, large balance sheets, and the ability to buy into weakness benefit from liquidations, because liquidations create size. In normal markets, size is hard to acquire without pushing price against yourself. In liquidation, size comes to you. Another beneficiary is anyone managing risk on the other side of crowded positioning. If a trade is one-sided, the unwind can be profitable for those positioned for volatility or for those who are structurally short optionality and need to reduce that exposure. When volatility spikes, dealers adjust hedges, funds rebalance, the market reprices correlations. These players don't need to predict the crash. They just need to know how volatility feeds back into flows. So when people say they needed lower prices, the mature way to hear that is certain participants needed the market to clear the leverage because the leverage itself was distorting price discovery and raising systemic risk. This is the part no one likes to say out loud. Exchanges and clearing systems are designed to survive. They do not exist to protect the most optimistic participant. When a market becomes unstable, the system's priority is to reduce risk, even if that means forcing liquidation at terrible prices. Lower prices in that moment are not the goal. Lower risk is the goal. Lower prices are the consequence. And once you accept that, the behavior makes sense. Volatility rises, the system tightens, leverage exits, price overshoots. Then, and only then, does the market find a new equilibrium where participation is dominated by players who can fund the position without borrowing the future. Now, let's walk through how this mechanism works in plain language. Think of a futures market like a stadium where the tickets are cheap, but the ushers can ask you to pay more at any time if the crowd starts surging. As long as the crowd is calm, you can hold a big seat with relatively little cash down. That's leverage. But if the crowd starts pushing, the ushers raise the security deposit. Suddenly, everyone who came in with barely enough money has to either pull out a wallet they don't have or leave the stadium immediately. When thousands of people try to leave at the same time, the exits become the problem, not the seats. Margin hikes are those ushers raising the deposit. They are not about changing the story. They are about controlling the crowd. Now add in modern risk management. Many funds use systematic rules. When volatility rises, their models cut exposure. When drawdowns hit certain thresholds, they de-risk. When correlations shift, they rebalance. These are not emotional decisions, they are programmed. And programmed decisions can synchronize across the market, creating the illusion of coordination. Then add in the human layer, risk committees, prime brokers, internal limits. That is why time compression matters. When events compress, survival dominates, and survival decisions are correlated. So what does this suggest going forward without turning analysis into prediction? Historically, after a margin-driven liquidation, one of three outcomes tends to follow. The conservative scenario is stabilization. Price stops falling because the forced sellers are largely out, volatility cools, and the market trades sideways while participants reassess. In that world, the key indicator is whether margins stop rising and whether open interest stabilizes instead of collapsing further. If open interest keeps dropping, deleveraging is still in progress. If it stabilizes while price stops falling, the forced component is likely fading. The moderate scenario is a rebound driven by the absence of forced selling and the return of structural demand. If ETF inflows resume after the shock, if physical premiums hold up, if funding markets relax, and if volatility declines, price can retrace a meaningful portion of the move. In that world, watch for signs that the market is no longer trading like a margin event. and is returning to trading like a supply and demand instrument. The aggressive scenario is a deeper, broader liquidity event where metals become collateral sources for raising cash across portfolios. That happens when stress spreads into credit or equities, and participants sell what they can. In that world, metals can fall even if the long-term thesis remains popular. The indicator there is not a metal-specific headline. It's stress elsewhere, widening credit spreads, disorderly moves in rates, and signs of cross-asset deleveraging. Notice how none of those scenarios require a magical story. They require monitoring mechanics, margin changes, volatility, open interest, ETF flows, and the behavior of funding markets. If the next margin update is lower, that's a signal the storm is passing, even before price responds fully. Now, circle back to the dislocation, because this is where a lot of investors and viewers get trapped. They see the crash and conclude the entire theme was wrong. But themes can be right while trades are wrong. The market can be structurally supported over years and still experience brutal, margin-driven collapses over days. This is why institutions often win. They separate the concept from the entry point. They can hold through volatility because their funding is stable. They can add into weakness because they have cash. They can wait for forced sellers to create discounts. Retail participants, and even many smaller funds, often experience the opposite. They arrive late because the theme becomes visible only after price runs. They express it with leverage because leverage makes the trade feel powerful. Then they get introduced to the rulebook, where margin and volatility decide whether they get to stay. That's the divide. Not intelligence, not courage, attention to structure. The wealth gap in markets is often an information gap about mechanics. Institutions move first, not because they have a crystal ball, but because they understand which switches get flipped when volatility rises. When the switches flip, they are prepared and others are surprised. So when you hear they needed lower prices, interpret it as a statement about transfer. Crowded trades tend to end with transfers. From weak hands to strong hands, from borrowed conviction to funded conviction, from hot money to patient money. And the moment of transfer often looks like chaos. It looks like an accident. It looks like irrationality. But when you map the timeline, you see the logic. Catalyst, volatility, margin, liquidation, transfer. If you want to stay oriented in this kind of market, don't anchor to narratives. Anchor to indicators that reveal whether the move is still being driven by forced mechanics. Watch margin updates. Watch volatility. Watch open interest. Watch ETF flow data. Watch whether price behavior becomes two-sided again, with buyers actually absorbing sell pressure instead of stepping away. The key question is whether the market is still in a phase where the rulebook is forcing actions, or whether it has returned to a phase where participants are choosing actions. That distinction changes everything. This is Roki Studio Finance, where we decode what matters before its headlines. If this connected dots you hadn't put together yet, you know what to do. And remember, the real question isn't whether this story unfolds. The question is whether you recognize the mechanism early enough to understand what the market is actually doing, while everyone else is still arguing about what it should do.